We are live from the George W. Bush Institute in Dallas, Texas. I'm Diego Sanchez, president of HousingWire, and I'm joined today by Joseph Panebianco,
Yes.
the CEO of AnnieMac's Home Mortgage. And I'm going to call you Joe.
Please.
Joe, I would love for you to just, for those in our audience that don't know, what is AnnieMac's Home Mortgage? What's your product focus and what's your geographic focus?
Okay, so AnnieMac's Home Mortgage is a nationwide lender. Our natural habitat, as I often say, we're distributed retail. So while we do about 30% of our business B2C, 70% of our business is really B2B. We try to look for how we can add value to our referral partners, which are real estate agents, financial advisors, et cetera.
And you've been working on some M&A?
Yeah.
Over the past couple of months. And are you able to share a little bit more about that right now?
So it's funny. So I try to do about 2 acquisitions a year.
Okay.
And I'm actually working on 2 right now. But it's very difficult to share in today's market because I would say there is a cacophony of recruiters that if they get a whiff of what's going on within a company, and not so much for AnnieMac's sake, but for you generally have an ownership team that is doing what they can to hold their team together, and it's hard enough to do it through a transition. But I can give you some specifics on what we're looking at.
Yep.
There are a number of IMBs who just have phenomenal sales organizations and even operation staffs. But, because of their size, they're either deficient in execution, they don't have the necessary agency tickets, they don't have the tech stack, or quite frankly, they don't have the capital. Mm-hmm. A lot of folks exited 2021 and 2022 with a fair amount of capital, but let's not kid ourselves. It's been, quarters of a difficult time period. Mm-hmm. So what we've been able to do is put together a really good value proposition for folks in that cohort. But again, retention is a large part of it. But it's, you hear folks like Stratmore who they do a great job. Sterling, folks that are out there, they're out and about doing it. And I think their first advice is do no harm, right? The Hippocratic oath, I'd say, of M&A.
Yeah, we are somewhat acquisitive ourselves and have done 4 acquisitions over the past 5-6 years. So I definitely know that, know that motto and use it in our acquisitions. Makes a lot of sense. What are you targeting? What's your ideal mix of organic growth, growth internally versus inorganic growth, where you're going out and acquiring a company?
Yeah. So can I put a third bucket in there?
Yeah.
That's, I think, often overlooked. So I'll start with organic growth.
Yep.
So organic growth, there are 2 primary focuses of ours. One is higher conversion rates. The other one is increased lead flow, mm-hmm. right? So higher conversion rates is something that, gets a lot of lip service, but I don't know that people actually align their business model to it. So for example, do you have 1 or 2 or 3 things within your tech stack that are specifically tracking conversion rates? There's an industry average for conversion rates. Many people likely don't know it. Some people do. But the question is, do you know every single loan officer's conversion rate? And do you know where they are better? Can you bifurcate it or trifurcate it into the different buckets of loans they do? So that's one area that we look at internal growth of organic growth.
Yep.
And then, of course, there's acquisition. And you could break acquisition down into individual loan officers. You could break it down into branches. You could break it down into divisions. And you could break it down into firms. In an ideal way, firms sometimes are a lot easier to pick up and move because you've already got the buy-in of the senior leadership. You're not playing tit for tat with, you make an offer, then there's a counter offer. You get through that. But that's been a very active space. But I will tell you, the folks around me know I use the phrase, it's like kissing a lot of frogs, right? And I mean this sincerely in that, anyone reading this, I would implore you, don't wait until you're in the throes of death before you head down the M&A path.
Yep.
If you see it 3 to 6 months out, you're going to serve yourself better. I mean, I would tell people out there as well, if you can make it, make it. Like, keep pushing, right? I get no great joy in seeing other companies having to fold into other. It's just a natural part of the business, and mm-hmm. you're in most of life, you're either eat or be eaten. But having said that, for those who can take some of the advice from today if they were here. Make sure you understand your costs. Make sure you're not spending too much on tech that's not being used. Make sure you really understand who your business is, who your clients are, et cetera. But for those who have done all that and it's still a tough market, and you see that the end of your capital maybe is near, or you're getting into trouble with some of your warehouse line providers, I really urge them to start looking, because the benefits, it would be better for them. Right?
Yeah.
Then the third bucket, which I think no one really talks about, is retention.
Yep.
The best place to grow is to not lose your current staff, right? So I think the industry, and I believe this is a Stratmore number, I think the industry turnover rate is about 33%.
Okay.
We're very proud, although not happy enough with it. We're at 23%, and our goal is to get to 18% for this year. And so within that, you have to have strategies as well. You have to, first off, identify who really is worth saving, right? Because we all understand there's three broad buckets of originators. You have your top performers, your middle, and your lower, and we can even break those into individual buckets. But if you can, the reason why the industry has been so recruiting crazed is, one, production is lower, no question, and you have a fixed cost within this mortgage industry you need to maintain. But two is because your folks are getting picked off, right? And so if you can hold on to recruiting, I would say that's our first priority, making sure we hold on to the folks we have.
That makes a ton of sense. And you talk about retention, and so there's retention of LOs,
Yep.
but there's also retention of your customers and recapture of those customers. How do you think about servicing and then opportunities down the road to do a second or a third transaction with customers that you do the first transaction with?
Yep. So two questions there, I think. I'm trying to break them down for
Yeah.
you. So first question is servicing.
Yep.
So, I hear from some very smart people who are probably right, is that get as much servicing as you can, right? But then when I've taken a look back at that, I say to myself, okay, we are a distributive retail model, right? We like to think of ourselves as the Nordstrom of mortgages rather than maybe the Dollar Tree store, right? So arguably we have a larger infrastructure, and we have maybe some higher comp plans, et cetera. So we don't really have the ability to be as price competitive as, say, a small broker or a consumer direct division, although we have one of those. So there have been times where I have been active seller of servicing and or just not retained as much. And that's simply because, a year ago or so, when rates were at 8%, I understand that in order for me to break even on the investment in servicing, that needs to be on my books for 3.5 to 4 years. Mm-hmm. And at any given time, if rates were to drop precipitously, we're so purchase focused. It'd be very difficult to make that investment. Right? But having said that, over the long term, love servicing. So then the question you're getting to is, how do we retain that, right, when we have it? So what we have established is more of a journey. I think what happens with a lot of mortgage companies is rates drop and the panic ensues.
Right.
They start calling. So you have to be in touch with these clients, and not just an email telling you what your home value is, or not just an email giving you a Thanksgiving recipe. Like, you've got to be in touch with these folks. Mm-hmm. You have to let them know specifically what their potential savings is. You've got to let them know that you're still there. I think there's a great statistic in the real estate space, and please tell me that 85% of all people love their realtor, but only 13% of them use them again.
That's right.
Something like that.
Yeah.
I think it's a little higher on the mortgage side, but having said that, with all the transitions that's gone on in the mortgage space, your customer might not even have the same loan officer there.
Right.
So it's about the journey, and the journey is it's a multifaceted approach to making sure that these people know you're there. You're not just a strange entity to them. This way, when rates do drop and they get your call, they say, "Oh, okay, Diego, yeah, what do you got?" And you go through the process. And then, of course, and once you pull the credit, you're going to get a flurry of calls, but this also helps keep that at bay. Yeah. Because they already know they have a trusting relationship, and you just can't do that with a phone call and rates drop.
Yeah, that makes sense. So we're at the Housing Economics Summit, and I think you're a data guy. I think you like the numbers and are well aware of what's happening in the market. And it's been a tough market for a couple of years. Are you sensing anything, whether it's in your sales force or in your customer base, that tells you that there's a light at the end of the tunnel?
So I would say this. So I'm a glass is half full guy.
Yep.
But I will tell you that the prospect of it's going to be morning again soon is a very dangerous one for salespeople because it sort of keeps them at bay. It keeps buyers at bay. So what we try to do is look at, listen, irrespective of the environment we're in, we've got one of the best markets in the world. What do you remember that? So we did a little over 4 million units last year as an industry, right? And depending on loan size, that's about 1.4 to 1.6 trillion dollars worth of business. You can get, as I say, your unfair share of that if you just stick to the basic fundamentals of blocking and tackling in this industry. So I know your question was, do I see anything out there data-wise? Yeah, you can see some cracks. So it may be a bit too much for this discussion, but there is this sort of theoretical neutral rate, which is neither in recessionary or inflationary within the economy. I believe our economy has been running hot for a long period of time. I also believe it's starting to slow.
Yep.
No one knows the rate of when we'll reach that critical point where it's slow enough where rates will get back to the magical 6% we're talking about now.
Yep. Do you think 6% is the magic rate?
I do. When we had our best month last year in October.
Yep.
And if
When
you back
rates
up
dipped.
60 days from that, you saw rates dip. And so it does tell you that there is a lot of pent up demand, and not just for purchases, for refinances too. I know everyone's very fond of showing the distribution of outstanding mortgage coupons, but you have to remember that person with a 3.5% mortgage has now spent 2 or 3 years in there. They've probably incurred some student loan debt, maybe not. They've incurred some credit card debt. They've had to maybe go out and buy a new car. So there's a confluence of circumstances that change someone's ability to afford their total payment rather than just their mortgage payment.
So in more difficult markets like the one we've been in, it's not an expanding pie. And so if you want to grow, you need to take market share.
You do.
And so you have some programs that I think help you do that. Could you tell me a little bit more about Cash to Keys and how that enables your sales force and your team to grow?
Yeah, I would love to. So we were, to the best of my knowledge, the first person to come up with a cash platform in the IMB space. And the premise was, how can we elevate buyers who maybe have lower credit scores or they're not on top, put them at the top of the hierarchy in terms of buying a house, plain and simple. How can, and if you look, again, hierarchically, it's the cash buyer, stands up, then the well-heeled conventional buyer, and then, you go down the convention, then maybe you get to VA, and then maybe you get to FHA.
Right.
And realtors are, bless their souls, they do a great job, but I've had direct discussions with realtors that won't even look at an FHA convention.
Sure.
They won't even look at it. So our platform, we thought, what's the problem we're solving? Right? The problem we're solving is on the real estate side, the real estate agent side, our B2B and our B2C. Right? They just can't get in front of everyone else. So we thought, okay, what if they could come in as cash buyer? So I set up a separate company called AnnieMac's Cash Private Equity. That's what funds this. And it has been our single biggest market share grab. And it's been great. We've been able to unlock a ton of commissions. I think $20 or $30 million worth of commissions just for realtors over the last year.
Right.
We've done, $600 or $700 million, soon to be $1 billion in just cash to keys deals. And the other component of it we then solved for was what we call buy now, sell later. So this enables somebody, as we all know, to buy that house before they have to sell their house, because nobody wants to live in a hotel or a mobile home for 3 months. And while you're giving me the opportunity, I will plug. I understand now there's a lot of detractors, but we do an apples to apples comparison against all the majors and the third party people that do this, and we're constantly trying to hone it, and we're still, I'd say, light years above our competitors in terms of that offering.
Yeah, let's keep talking about it because, we heard on stage this morning from Logan, Motoshami, Mike Simonson, that it really is a tale of many different markets across the U.S. There are places that are still sellers markets.
Sure.
And there are places that are turning into buyers markets. Yep. And so I would imagine that particularly in the sellers markets, something like Cash to Keys can be very helpful in getting people into a home. Are you finding that Cash to Keys makes you more competitive in those markets that are still sellers markets?
Oh, 100%. Not only makes it more competitive, it is absolutely elevating the folks who would not even be in the market
Right.
to be able to get the home they want. And that's a meaningful thing. We have a number of different stories we could share, but the one that I really love is we had a veteran who had lost out, I think, on 18 homes. They bid on a house with 63 other borrowers, and the number's not right, but the order of magnitude is, and they won it. And we have this great, and that happens a lot.
Right.
You know, I'd say the hardest part about our cash buyer platform and our buy now, sell later platform, it's so different. It's very difficult to get realtors and buyers to actually understand it. And they're always looking for, excuse the expression, how am I getting screwed?
Yep.
Right. And our thing is, we want the mortgage, right? And as you were alluding to earlier, with retention, we know that whether it be 3 or 5 or 7 deals, we want to be on you with that entire journey.
Yep.
And so we're willing to make that investment up front. Some people make that investment by putting names on stadiums. Some people make that investment by doing commercials. We make that investment as a way so that our referral partners have a value-added proposition that's going to get them more loans and really make the American dream of home ownership a reality for a lot of folks who they're not in the game right now.
Right. Well, I've loved this conversation. Really interesting company that you're building. Thank you so much for joining me today.
It's been 100% my pleasure.
Awesome.
Thank you very much, Diego.